Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host for the Five Talents Podcast. We are super excited, as always. We have another amazing guest, Mr. Kenneth Kastner. Kenneth, brother, thank you very much for joining. How's it going?
Great. Thanks for inviting me. I'm feeling great today.
Man, I really appreciate your time and your evening as well, coming all the way from Israel. And Kenneth is going to bring us just really an amazing insight for those that are investing in the U.S. and that are foreign investors. A lot of different insights to think about from a tax perspective, from a wealth creation perspective, strategies on how to do so. And I'm excited because I do get this every once in a while. Kenneth, in our syndications, we have investors that are in other countries, and I don't know how to answer any of their tax questions. I just go, you need to talk to an expert, and I'm happy now we have an expert to at least record a show. I can steer them to this conversation, and then hopefully they can reach out to you, my friend. So thank you very much. I appreciate it.
Sure. That's great.
Well, Kenneth, let me introduce at least you for a couple of bullet points, and then I'll turn it over to you for an introduction. So I met Kenneth from LinkedIn, and on LinkedIn, we've had some amazing commercial real estate conversations, challenges that we've done together. And Kenneth has put out some really great content, and it's very entertaining as well as informative. But he, that's where I originally met him. And I go, man, this guy's amazing. What does he do? Well, he's a CPA. He lives in Israel and he provides U.S. real estate tax guidance for foreign investors. He had a previous a run with EY, so Ernst & Young. He was the international. He worked at the International Tax Department, and then most recently, he serves as the tax director for U.S. Real Estate Tax Department at GTS Israel. He formed his own, tax solutions, providing personal, really reliable online service platform for foreign investors that are looking to invest in U.S. real estate. And then now he's also a partner of another firm. So let me turn it over to you, Kenneth. Give us a proper introduction. Tell us who you are, what you do in your own words, and we'll just start a great conversation, my friend.
All right. Yeah. The last part is a really new development that just happened in the last few weeks. I was asked to become a partner in a local Israeli accounting firm called VBIR. And so now I lead the U.S. tax department over there. That's exactly what you said. I take care of anybody, not necessarily Israelis, but anybody who's not a U.S. citizen or not a U.S. resident, and they want to invest in the U.S. So I help them with the U.S. tax side. There are a lot of differences between U.S. citizens and non-residents, and like you said before, when somebody comes up to you and they say they're not a U.S. citizen, you don't know what to do with them. So a lot of people, I've heard that a lot of times, they just sometimes don't even accept them into their group for investing because they don't want to deal with somebody who's foreign. So now anybody who has that kind of situation could have a solution that's appropriate for them. So I guess we can start out by saying what has to be said before anybody invests in anything in the US or anywhere in the world. is to go in with your eyes open, not with your eyes closed. If you go in with your eyes closed or in a dark room, you're gonna trip over something, you're gonna fall. So it's really crucial to do the planning, not just for the investment and to check out the investment, but also understand basic concepts of U.S. tax
Yeah.
before starting the investment, so that you don't have any surprises later, and so you can do the proper planning and get the most out of your investment dollars.
Absolutely. There's on our side, I always hear a few questions. One of the questions that I hear often is well, I've never invested in commercial. I've never invested in this, or I've been investing in single family for years and I'm not sure what to do. Right. So these questions come to me and I usually turn it back to them. And I try as much as possible to say, well, what are your goals? Right. What are you trying to accomplish? Are you trying to, have wealth creation? Do you care about cash flow? Is it all about net worth? Are you trying to retire at a certain time? So usually your goals will then lead you to the right solution. And I'm assuming it works the same exact way on your side from the tax perspective. Yes.
Absolutely. If it was a one size fits all, then I wouldn't really have a job. I'd just put out a book, and everybody just follow the instructions, and that's
Yeah.
it. Obviously, everybody has a different story, different situation, and the tax advice and the tax consulting and tax planning is going to be
Yeah.
different for everybody. Everybody
Yeah.
has their own individual situation.
Yeah, that's awesome. And before we get too technical into the tech side, tell us about yourself also. Like, how did you even get started in this world? Have you said, hey, I'm going to be a CPA. This is what I want to do. I've always wanted to do this. Or was it real estate that drew you in, or what was it in general? Tell us a little bit about this background here, or investing in general.
Yeah, it wasn't the real estate. The real estate came afterwards. It was more like, yeah, I have to do something that's be kind of like appropriate for my type of composure and my skills. So I was trying to figure out what I like doing, what I do best, and just in the day to day, I like I like analyzing and paying attention to small details and finding things. So it was basically I was considering either to be a detective, something in forensics,
Wow.
or accounting, something with that kind of thing, because I like paying attention to those details. And just as opposed to a lot of other people apparently that think it's just boring or annoying. So that's something that I thrive on. So I went into that field, and yeah, and only in I guess after I finished working at EY, and I was approached by the owners of GTS Israel to join them. That was essentially the first time that I started thinking about the real estate side, and even in general about the U.S. side. I was basically doing Israeli taxes until then, international things, but focused on the Israeli side. And basically, in the last, I don't know, 7-8 years, I've been focused almost, probably more than 90% on the U.S. tax side. So that's been my focus, and not just the U.S. tax side, but specifically my niche has become real estate, and not just real estate, but real estate for foreign investors. It just
Yeah.
it just developed that way, and I never looked back.
Well, you could have been on this show we call a CSI, crime something investigator. I don't know what the show is, but
Crime
it's
scene
forensic.
investigation.
Yeah, there you go. Forensics, and you chose the number forensics side of things, anyways. Excel and data. I love it though, because your skill is so valuable in our side of the investing side. It's important. It's fundamental. It's at the core. It's at the soul or the analysis of the deal, right? You're trying to figure out, hey, does this deal work? And I need to figure that out. And then also why are we doing all this work? Well, we want to keep as much profit as possible after taxes. We were trying to keep it. So anyways, that's awesome to hear. And thanks for sharing a little bit about your background as well.
Yeah, if you don't
So
have patience for to go through a contract, of 20, 30, or 50 pages, you don't have patience, then yeah, then there could be issues over there. So
You got to make sure the tax rules and tax laws and how it all, everything affects you one way or
catch
the
those
other.
typos.
Yeah. So help us, give us a little bit about, I guess, your client base, what you see primarily on a daily basis. So we can, as we're having this discussion, we understand, do you have a bunch of commercial real estate investors? Are they foreign investors in all different types of asset classes and different vehicles? And, maybe to give us the high level, and then we'll drill down a little bit.
Okay, so naturally, most foreign investors, since they're not in the U.S. physically, they're not as active as other types of investors or real estate professionals. So they're on the most part they're going to be passive investors. Whether it's syndication or whatever you want to call it, partnership, going in as a group, as most with a group of foreign people. There are a lot of, for example, there are a lot of companies all over the world, but especially the ones that I know here, in my backyard in Israel. There are a lot of real estate companies that create these groups of investors, and they pool their funds together, and then they go in and do whatever they do in the U.S. But for the passive investors, at the end of the day, they get a K-1, and they have to file their tax return. But yeah, the partnership or the company that operates in the U.S., it could be commercial, it could be single family, it could be anything. But obviously, rental income is rental income, and depreciation is depreciation, and cost segregation is a different story. I'm sure you already spoke to Yona enough about that. I don't have to get into that, but yeah, for sure, cost segregation is still something that's really good for anybody, even for foreign investors. Although I think I'll talk about this maybe a little later about being careful with things like that. There are things that are like tax deferrals for U.S. citizens. Foreign investors have to be careful about that, how they structure their investment, in order to make sure that they don't get caught up with double taxation because of different laws that they have in their home country. So I think we'll touch on that soon.
Well, let's hit on that, because I'll definitely go back to, if we can fit it in, depreciation, cost segregation, tax benefits. But you said double taxation, right? That's obviously, who cares what country you're in or where you're investing? I don't get double taxed anywhere. So help us describe, what this pitfall is maybe, and then how foreign investors can avoid some of these things.
All right, so let's take a step back. In general, what double taxation is for these kind of investors, it's when you have two different countries that want tax on the same income. Okay, so essentially you have, let's just talk about Israelis. Okay, you have an Israeli resident who's investing in the U.S. in real estate. So the real estate is in the U.S. So the IRS wants tax because there's rental income on its soil, right?
Yeah.
And the Israeli tax authorities want tax because the law in Israel is that Israeli residents are taxed on their worldwide income. Okay, similar to Americans, that American citizens are taxed on their worldwide income. In Israel, it's not citizens. It's only if you actually live in Israel. If you're an Israeli resident, then you're taxed on your worldwide income. So in that case, where people live here and they're investing in the U.S., they have this issue of potential double taxation. Now, there's a tax treaty that the U.S. has with a lot of countries, including Israel. So this tax treaty is aimed at avoiding and preventing double taxation, and essentially it has the rules for how they're gonna decide who gets the tax and how much. So so there are a lot of different sections in the tax treaties, and for all different kinds of income, interest income, dividend income, personal labor, gambling, name whatever you want. But let's focus on the real estate part. Okay, the real estate part is going to be relatively simple, or I'll just keep it simple for the purpose of this this conversation. real estate is connected to the ground. Okay, so the treaty says that wherever the real estate is, that is the country that has the first right of taxation. Okay, so in this case, the real estate is in the US, so the US has the first right of taxation. Okay, and then if there are any leftovers, then the other country can get. Now, what are these leftovers? The leftovers means not every country has the same tax rates, right? The US, different laws. Obviously, every country has to do whatever they want, right?
Sure.
So, for example, in most cases, the US has lower tax rates than Israel. Okay, so let's just take that as a general concept and idea. So, if the investor is going to pay tax in the US, okay, they're going to essentially be paying less than what they would have paid if they were paying Israel, because Israel has a higher tax rate. Let's say in the US it's 10%, and in Israel it's 15%, right?
Yes.
So Israel wants 15% and US only wants 10%. So the tax treaty says, okay, pay US the 10%, okay, but that extra 5% pay Israel. Okay, so you're not going to pay 25%. It's not going to be 10 plus 15.
10 plus 15.
That's a double taxation. You're not going to do that. You're just going to end up paying the amount of the percentage of whichever country has the higher percentage of tax. So in this case, if it's 10 or 15, he's going to pay 15. How do I split it? How do I split that 15 up? So the treaty says give 10 to the US and 5 to Israel. But for the investor investing as an individual, they'll just pay that 15. I just made up the numbers. It's not really 10%, 15%, but that's just for the example.
Yeah.
And that's if they're investing as individuals. Obviously, there are ways to invest. Opening up a corporation or opening up a pass-through entity, an LLC, partnerships, all that kind of thing. So there are certain entities that flow through to the individual, and then they're taxed as individuals. But there are some companies that are that are closed companies or blockers, like a C corp, and in that case, it would stay in the U.S. until the foreign person takes out dividends from that company.
Yes. So, okay, got it. Yeah.
So that's also a way to get out of those other tax deferral.
Defer taxes. Push it down the line. Kick the can a little further. Right.
Exactly.
Yeah.
That's what I was getting to with the depreciation and the cost segregation.
Yeah.
And I'm going to talk about also the 1031 exchange.
I love it.
Kind of like group it all together, because these are all tax deferral methods.
Okay. Well, this is awesome. Let me pause here, because we've already uncovered some pretty good nuggets, I think, for our foreign investors. So let me just recap a couple things I heard and then just confirm, make sure I'm right, Kenneth. Right.
All right.
So the international tax treaties that are already set up, they're already in place. They define all this stuff in advance. Hey, you're in Israel versus another country versus Australia versus Canada versus the US. And the real estate is connected to the ground. So they say, hey, the first taxation or the first entity that gets the right to tax it is the US. And if ours is lower than the country of the foreign investor or resident or whatever the tax rule is in that country, then they get the difference, so we can avoid the double taxation, or a foreign investor investing in the US can avoid this double taxation. So that's kind of set up there. And what we're trying to do, obviously, as any investor in any country, I would like to minimize my taxes as much as possible. So one of the strategies that I'd like to break into now. Oh, and that was all right. Is that correct? Everything I just said?
Yeah, you were definitely listening.
Okay.
You took good notes, or your head is, I don't know, you're very sharp. Yes, exactly. You summarized it better than I could.
No, you're teaching me, my friend. So I'm along for this educational ride. So thank you. So now the strategy in the tax side of it is to defer my taxes. The taxes are owed. The U.S. wants their money, as Israel wants their taxes as well. But of a strategy, if I can push that down and say, well, I owe it, you're correct. But if I don't have to pay it today, or I can even choose when I want to pay it, 1 year versus the next year, I'm in a better situation if you have the choice. I had a CPA that I work with on my side, and he goes, look, what I'd like to put my clients in a position is where they tell me how much tax they want to pay in which year. And that's ideal. And I was like, man, I like the way you think. I would love to do that too. But so let's break into this conversation. 1031, cost segregation studies, accelerated depreciation, where do we start? What's the best, take us through the best conversation here, Kenneth.
Right, exactly. So those strategies are obviously a lot more difficult when it comes to foreign investors because you're dealing with another country as well, not just the U.S. side. So you have to take that into account as well. So the regular standard tax deferral methods, like we mentioned, the 1031 exchange. Okay, 1031 exchange. Whoever doesn't know is a way to defer taxes in the U.S. by exchanging one property for a different company and not paying the capital gains tax at that point, rather paying the capital gains tax only in the future when they eventually sell the property or the last property in the row. And there's also ways to get a step up in basis if they just don't ever sell it and they just transfer it on to their kids and whatever. But the problem is if a foreign investor is investing as an individual, again, not as a corporation, as an individual, then the foreign country may not honor that tax deferral. So even though they're going to be deferring the tax in the US, but their foreign country, their home country, essentially for them is their home country. It's not foreign for them. Their home country will demand the capital gains tax at the time of the exchange. So essentially that could lead to double taxation because, or at the least it's pointless, right? If they're going to get a tax credit in any case, they're just going to pay the higher tax, then why postpone it in the US? Just pay it in the US because it's lower than Israel anyway. Pay the capital gains tax and you're going to just pay the, whatever's extra to Israel as opposed to paying the entire thing to Israel and then having to deal with maybe having to pay tax in the US in the future. So that's one pitfall to be careful of. And one of the solutions, like I mentioned before, is to have a C corp, because then like I said, the tax doesn't get to Israel until they take out dividends. So the corporation can do these tax deferral methods. They can keep flipping and exchanging, and at that point, it won't have anything to do with Israel because they're not taking out dividends. But the corporation is not always the best structure for each individual. Also, like I said at the beginning, everybody has to plan and decide what structure is good for them.
I'll give my nugget here on this topic. So I invested in our first several houses as an individual, and I put them under my name, my wife's name, us together. And it wasn't until we started accumulating more of them that I really realized, well, number one, it's a risk. And number two, it is also different from a tax strategy. And I kind of had the high level rule, which was broken down to me in one of the corporate structure classes that we took, was they said LLCs are great for risk and asset protection. If something happens on a property and somebody, tries to come after it, everything's under my LLC now, or from my rentals, we moved it over, but that's risk and asset protection. And most people think, oh, that's tax mitigation, but it's really a corporation will help you more the taxes. LLCs help you with risk and asset, and corp will help you with taxes. And so this strategy, like you're saying, if one of your goals is, I want to defer capital gains, I want to figure this stuff out, then if you work with an expert, everybody's situation is different. For me, it was, well, actually, I have multiple LLCs and I have C Corp and I have, this umbrella, structure that kind of defines every different role within my company. One does nothing but holds. One does nothing but manages. One's very active and one's very passive. And, we kind of have that structure, but I definitely recommend to avoid that because, man, in 2019, we absolutely crushed our taxes. We paid like zero taxes. We got a huge return. We cut our W-2 withholdings on the W-2 side because of the structure. cost segregation just crushed our what we owe, and I had a big check. We were able to to invest faster again. But that's the insight that I have around this. How is that? How does that translate to the foreign investors? Is that pretty similar?
It is and it isn't. It also really depends on what type of investor we're talking about. If we're talking about a passive investor that just puts a small amount of money into this whole deal, and then it's not going to be worth it to start doing all these fancy structures because the cost of handling the structures is not going to it's not going to make things worthwhile in terms of the tax saving. But if we're talking about somebody who's investing bigger money, then for sure these tactics are definitely the way to go. In terms of the corporation, in terms of the cost segregation, again, Yona will tell you also, if somebody's just putting in $100,000, don't do a cost segregation study on a house that's a single family. It's not going to be worth it. But if you have, $500,000, $1 million, then you can do a cost segregation study. But again, if you're going to be doing that, it's probably a good idea to invest through a corporation and not as in a pass through or as an individual, because, for example, in Israel, they won't accept that cost segregation study, and essentially they'll recalculate the depreciation in Israel. And you won't be saving anything at the end of the day. So that would be a good idea for corporations. Obviously, the negative side of corporations is the higher, depends if higher or lower, but the different type of tax, the corporate tax as opposed to individual tax. When you're talking about foreign investors, the only income that they have in the U.S. is from this real estate. They don't have a W-2. They don't have any other. So their marginal tax rate starts off at zero. Okay. So when they're first investing and they get, whatever, they even get $30,000 profit a year. Okay. From real estate rentals, they would pay 12% tax as an individual. And if they have a corporation, they're going to have to pay, 21% plus when they take out dividends, another chunk. So, for at the beginning, it might not be the best idea to go all out if somebody's just putting their foot in the water and testing the waters at the beginning. You can always check the box later and turn an LLC into a corporation when it gets to that point.
It sounds like I'll tell you what is very beneficial from everything that you're saying. For any foreign investor listening, you should probably reach out to Kenneth, reach out to Yakov, because he's sounds like a pro, which is exactly why I wanted him on the show, to kind of help any of our foreign investors that are trying to figure this stuff out. Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review, and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. So what advice, what recommendations can you give to anybody that's trying to learn, no matter what country they're in, and they're thinking about investing passively into syndications we talked about, into some commercial real estate? Any advice or tips, or what to start with, or what do I do first?
Well, obviously there's the IRS website, which has so much information, basic information for any taxpayer. So, there's the whole oceans worth of information, at the source, right? The source, the
Yeah.
IRS themselves. But there are plenty of other courses or presentations or webinars or things that are going up, not just from the investment side, but also tax professionals also every now and then have these kinds of trainings or presentations. I do it often locally. What I'm doing now is also helpful, getting people to be aware of these tax concepts on podcasts. So I think that whatever way they're going to go about it, if they're a self-learner and they like reading, or if, doing it with some other method, the bottom line is do your homework beforehand, no matter what it's going to be.
Yeah.
So yeah,
And hire a pro like you.
for sure.
Oh man. I mean, I like to learn about this stuff, but I like to learn like the 100 level, maybe sometimes 200, but I'm relying on the experts. Like you're my level 3, you're in my level 400. I understand the high level. Tell me the best way. And that's why I want to use an expert or a pro like you. And I found so much success on the commercial real estate investing side, doing the same exact thing, right? Trying to get the best possible team of experts and pros around me. And I've had a lot of success on the commercial real estate side. But it really, when I look back at my professional career, it was the same thing. I had a lot of success because I try to put people that I thought were better than me around me. And if they're not better than me today, that's probably because they were younger or had less experience, but I knew in a few years they would be. So I try to put those people around me, and I've had a ton of success. So anyways, enough about your experience and expertise, because you're the man. Kenneth, what else on the same track, right? I've heard ITN, I've heard FIRPA. What can you tell us about those couple of topics for foreign investors? What is an ITN? I don't have a social. How do I get it? What's FIRPA? Maybe this will be a good couple points.
All right, sure. Yeah, I can definitely expand on those. The code words that you mentioned probably sound like Chinese to a lot of people, and I actually
Yeah.
I actually have a series of LinkedIn posts on FIRPTA. That in order to
FIRPTA,
make it
yeah.
FIRPTA, yeah, in order to make it interesting, I put a fish. I put a fish at the top of every LinkedIn post that I was talking about FIRPTA, and I turned it into like this kind of like a joke. FIRPTA, sounds like a type of fish, and then got people's attention, and then then I started talking about it in a fun and entertaining way.
Yeah.
So that's FIRPTA, which I guess I'll start with FIRPTA since I'm already talking about it. FIRPTA is a law from 1980, I believe. Which one of the things it says over there is that when there's a foreign person, we're talking about somebody who already invested, all right, and now they're selling their U.S. real estate. Okay, they have a house and now they want to sell it, and they're an individual. They're not a corporation. They're a foreign person. All right. So in that case, the law says that the buyer, okay, not the foreign person, the buyer has to withhold 15% of the sales price
Hmm.
and
Hmm.
send that to the IRS. We're not talking about the profits here, okay? We're
Yeah.
talking about 15% of the sales price.
Yeah.
Okay,
Yeah.
that's a lot. That's a lot more than what an investor would usually have to pay.
It'll change your
And
cash on cash return. That's for sure. It'll change those numbers, but go ahead. Sorry to cut you off.
yeah, exactly. So yeah, that's definitely a cash flow issue. And we were talking about also before about tax deferral methods. The whole idea is to be able to have cash available to make more investments. And if the IRS is taking 15% of the proceeds, then that foreign person won't have that big chunk of money to continue investing, whether it's going to be in the US or somewhere else in the world. They
Mhm.
won't have that money for a while, because the way to get that money back, I mean, essentially, why does the IRS take that much? They're afraid that the foreign person is going to run away, to a foreign country, and they won't ever see their money. So they take more than what they should get in the end as a
Yeah.
withholding All right. And they say, okay, next year you file your tax return. You show me how much you actually gained from the deal. And if there was too much withholding, then I'll give you back a refund for, for the rest of it. Okay.
Yeah.
But, if somebody's selling a house now in January, the next time they can file a tax return for 2021 is in over a year from now. Right. And then the IRS issues refunds, it could take another few months. So we're talking about, it could be in a year and a half until somebody sees all that big chunk of money. So there actually is a way to avoid it. And that's to request a withholding certificate from the IRS before the closing of this of the sale. Okay, there's a way to do that, but it's really important to do it before the closing. To give in the papers, the paperwork has to be done beforehand. And if that's the case, then the buyer still has to withhold that 15%, but they don't have to send it to the IRS yet. They just hold it in escrow with the lawyers and wait, a month or two or whatever, 3 months, whenever the IRS comes back with their answer.
Mm-hmm.
And if they approve it, then that money, or at least part of it, could be released immediately to the seller, to the foreign seller, and he wouldn't have to wait until the following year to get his refund.
Beautiful.
And
Beautiful.
yeah, so there is a way to do it, but it's definitely complicated. It's complex. Don't try this at home by yourselves, that kind of thing.
Yeah.
But that's FIRPTA.
That's awesome.
In a nutshell, FIRPTA in a nutshell. Obviously there are exceptions and whatever, but keeping things simple. And the other thing you asked was ITIN, or you want me to jump into that, or you wanted to say something about this?
Well, the FIRPTA part is, that's beautiful. There's the nugget right there. If you're a foreign investor and you're trying to figure this stuff out, this is why you want to have somebody that has your back and is a partner through the process to help you illuminate some of the, this is the pitfall and here's how to avoid it. So that's beautiful. Okay. Yes.
Just one more word about that. I just remembered that the responsibility for withholding is actually on the buyer. Okay. So even though the foreign person is the one that's not going to have their 15%, but if the buyer, the US person that's buying the place, if they don't do the withholding, the IRS is going to come after them. Okay, so they have to make sure not to say, "Oh yeah, I don't care. Okay, I'll give you the whole 100%. Go home and whatever." The IRS is not going to go chasing the foreign person. They're going to go chasing the buyer, and they're responsible to make sure that's done right. So it's very, very important whenever you're buying a property. Obviously, the lawyers, usually catch this and they deal with it. But even lawyers sometimes, or title companies, don't want to deal with this kind of stuff. They don't like dealing with foreign people and everything. Yeah. So I can also help the seller, the buyer side also, to make sure that they're in compliance with whatever withholding they have to do.
Very good. So very good.
Yeah, that's FIRPTA. ITIN is another 4-letter word, which is abbreviation for individual taxpayer identification number.
Okay,
that's ITIN or ITIN, call it whatever you want. But it's essentially a tax number for the IRS for people who don't have and are not eligible to get a social security number. Okay, so obviously that's going to apply to a lot of foreign people when they have to file a tax return. In order to be eligible to file a tax return to get a tax refund, for example, for this FIRPTA or whatever it is, for whatever withholding, they have to first have an ITIN. And the way to get an ITIN is to file a form with the IRS. But the IRS needs to identify the person. They just don't want to, just giving out tax numbers to anybody without verifying their identity first. So in theory, what is supposed to happen is the foreign person is supposed to attach their original passport to the application and mail it to the IRS overseas. Okay. Wow. And
their original document.
Original passport. That's what the IRS wants.
Yeah, send it over to some other country. Yeah, send it across. Wow. Right. Okay.
So the IRS realizes that's not practical for a lot of people. So what they did was they appointed agents all over the world. They trained those agents, and those agents could verify the identity and check out the documents on the IRS's behalf, and then just send a copy of the passport with the application to the IRS.
Yeah, that works.
Okay.
Yes.
So they're those agents are called CAAs. and the certified acceptance agent. Okay. So that's also one of the things that I do, by the way.
All right.
So I can help people with ITINs also.
Yeah.
Obviously, I'm physically in Israel, but even I've had people from other countries in the world that were willing and happy to send me their passport, with some sort of a private delivery company, FedEx or whatever it is,
Yeah.
straight to me, as opposed to sending it to,
A
big
government
bad government
agency.
IRS.
Yeah.
Good luck getting it back and finding it, whatever. So so even if I need to identify somebody, I still need to have the passport in front of me. But they could FedEx it to me, and I FedEx it right back, and they don't lose much time without their passport.
There you go. Well, that is super enlightening, informational, beneficial, whatever, all the right words for our foreign investors. I didn't know any of this information, and it just now feels like, okay, I can at least direct them to you, to this podcast, to get a little more information, and that was super valuable. There's probably much more if we had more time, but I want to be a good host here and not go over our allotted podcast time. So before you go, where can our potential investors or somebody that needs some more information on these topics for themselves or family or them anybody in general, what's the best place to reach out to you, Kenneth?
LinkedIn is the best way. This is Facebook Live, so I'm also on Facebook. You can reach out through my website, KastnerTaxSolutions.com, or directly to my email. My email is KennethDKastner@gmail.com. I'm sure you'll have that information also, written out. Whoever didn't write it down this second,
we'll put it in our show notes for sure.
Yeah, no problem. It's not too hard to find me.
Yep. All right. Very good. And I think on Facebook, it's Yakov. On LinkedIn, it's Kenneth. Yes?
Yeah. Exactly.
Okay. Very good. Well, very good. Well, I appreciate your time so much. Is there anything else that I didn't ask you about you're hoping to, that I did, or any last bits of wisdom or insight that you want to provide our listeners?
That's a good question. I think maybe we'll leave that for the next time.
All right.
I think we covered a lot today. Covered a lot.
We were moving.
It's 6:30 at night here in Israel. It's almost my bedtime,
Well, that's awesome. I sincerely appreciate your time. It's been a great, educational, podcast, and I think it's going to be beneficial for those investors that were kind of thinking about it, worried about it, just had some questions on, investing in the U.S. from foreign soil, foreign ground. So this is very helpful. Thank you very much, man.
I appreciate you also. Thank you.
All right. I'm your host, Abel Pacheco at the Five Talents Podcast. We really appreciate you joining, whether you're watching on Facebook Live or listening to this on our podcast. We appreciate you. Hope that you see the next show. And if you found some value or thought this was a great conversation, please go to our podcast, Apple Podcast, and give us a subscribe rating, 5-star rating if you thought it was super valuable, or at least a written review would be amazing. So I appreciate everyone. And Yakov, thank you very much, brother.
All right. Thanks, Abel.
All right. Bye-bye, everyone. See you later. Thank you for listening to this episode of the Five Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the Five Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked. Tell us your favorite guest. Give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the Five Talents Podcast.